Alright, so the previous video that I made on politics, I touched upon the economic health of the United States of America, and I touched on banks, so I wanted to give you at least a little bit more insight onto exactly how banks make their money. So I worked out a problem in a piece of paper here, so I can at least give you the hardcore numbers. If I'm looking down, so I'm trying to recall all the numbers, there's a lot of them there. But I made an example just based on today's numbers, real, actual numbers, and I used an example that it could happen to basically anybody. So what I utilized was, let's say the average person or a group of people, they have $1 million and they go to the bank and they deposit it with the bank. Most people will get either a money market account, or they'll get a CD, or they get a savings account. Either way, you're roughly going to be earning about 0.50% or 0.5% on your money, meaning that for that $1 million, the bank's going to be paying you $5,000 per year in interest for having your money with the bank. Now, banks have the ability, because they're members of the Federal Reserve, they have the ability to leverage that money minimally at a 1-to-10 ratio, meaning that for that $1 million that you have put with them, that you actually let the bank borrow from you at 0.5%, the bank can take that $1 million, go to the Federal Reserve, and they can borrow an additional $10 million at the Fed funds rate, which today is between 0 and 0.25% or 0.25% on that money. That means that at the highest rate for $10 million, the bank is paying the Federal Reserve $25,000 in interest. So between your $1 million and the $10 million that they borrow from the Federal Reserve, they're paying annually $30,000 in interest. Now, what the heck does the bank do with that money? Well, they create loans. Today's rate for the 30-year fixed mortgage, if you have amazing credit, you qualify for the best rate out there, is about 3.70%. Now, I utilize that figure because I assume that everybody's going to have a credit for this specific example. So just to give you an idea, keep in mind, the bank is paying $30,000 per year in order to utilize $11,000 to create loans, for which they're going to charge you 3.70% for a 30-year mortgage on a piece of property that you or your parents currently own. Now, keep in mind also that most people, after 5 years, they either refinance their property or they go ahead and sell their property. So these figures will just give you an average of what the bank has made every year for the first 5 years, assuming that everybody that got a mortgage either sold their house or they refinanced it. So for the 5-year term, which they paid a total, the bank has $150,000 in interest, they've made in interest alone $1.938 million. And they've gotten principal back of $1.1 million. That means that for the $150,000 that they've paid, they've actually made every single year almost 1,300% on their money. That's every single year. Year 1 they made 1,300%, year 2, year 3, year 4, year 5, and so on and so forth. That's just the average because I blended it. So this is how banks really make money. So it begs the question, when the banks got the infusion from the Federal Reserve, why did they not loan that money out? The answer is very simple, and it's very common sense if you just think about it for 1 second. The real estate market and everything was collapsing. When banks lend money out, they're actually buying things. Because if you were to get your house foreclosed on, who owns it? The bank owns it. So when the bank loans money out, what they're doing is they're buying a property and then you're paying them back. So you're technically buying it off of them, utilizing the mortgage over a period of time. Now, the bank didn't lend the money out because the market's crashing. The market's coming down really, really hard. So that means that they're buying things today at a price, assuming they would have lent that money out at that time, that tomorrow is going to be worth less. So by default, they would have been losing money. That's why banks held on to their money, and now is when they're actually going to start lending. Now, I will tell you this. The economy will turn around. There's a lot of things in the background. I actually spoke to one of you guys on LOL yesterday briefly. I was telling you some of the insight as to a sister company that I do business with up in Chicago, Illinois. And I'm telling you, the economy will turn around. There's a lot of money right now inside banks. But when that money, the banks actually release it, and it's not up to the banks, actually it's as high up as the IMF, which is International Monetary Fund, and the actual World Bank. When that money is allowed to be released, there will be so many jobs because there are so many developments out there that are just waiting for this money to be out there. We're talking about huge developments, not only in the US, but Central America, South America, Australia, abroad, all over the place, the Caribbean. There's so many developments and plans already in place that are just waiting for funding to go into their hands so they can start developing this, that the economy will turn around. So I hope this gives you guys some insights onto how the banks make their money. Keep in mind that when you do pay off a mortgage, the cycle just resets because somebody else is going to buy the house from you if you sell it, and now the house is worth more. They got a bigger mortgage at that point, probably a better interest rate, and now they just repeat it all over again. So the banks make a ton of money this way. So I hope this helped you guys out to understand how banks make money, and I'll talk to you guys soon. Take care.